And I wanted to address that rumor because what will happen is people will get in, and I've seen it before, people will get into silver, and then if it pulls back and they get angry if what was said doesn't immediately happen. I had it happen a couple of years ago. People were getting angry when silver fell back down to like the $21 range when it had been near 30 a few years ago, and they were frustrated. And I said, just be patient because it's coming. And now we're at silver 71 and it's more than tripled. And if you simply held it, you tripled your money in about a year and a half. So there is a longer term price trend up for gold and silver. Certainly the fundamentals are very positive. Yeah, I was just talking with some other market analysts about that about 30 minutes ago before we jumped on here. Gold was like up 25%, and then it went up, like you said, 73%, and then silver really launched this year as well. And gold truly had a breakout. Like from a technical perspective, I was like graphing like Fibonacci's and logarithmic patterns, and it smashed any level of resistance you could possibly, from a technical level, put on it to say, if it's going to stay within these bands, it's not going to break. Not only did it break out, it like obliterated any sort of resistance or pressure. And I was talking with my friends about it, and we're thinking that gold is basically sniffing out debt issues, interest rate issues. Something that Tavi Costa pointed out to me, he's a great chartist who looks at a lot of long-term ratios, is once governments get to this debt level and they have 4 to 6% interest rates on their long-term debt, then they start to have issues paying off that debt, and you start to get into the severe fiscal issues of a national economy. And so the U.S. has to bring interest rates down. And to that point, we peaked at 5 to 5.25% under Powell to now we're at 3.5 to 3.75 on the federal funds rate. So, and they're expecting additional cuts. Trump wants to put somebody in office is just going to cut. And so what they're going to do is they're going to continue to cut interest rates to bring the interest rates down on the long-term debt, to bring debt service down. And what that's going to do is flood the economy with money, and they're going to try to grow their way out of it. Will that probably work in the long term? No. But gold is sort of sniffing out the fiscal issues. And if you put that together with things that have happened in international geopolitics around SWIFT and Russia being taken out of it, and the fact that people are de-dollarizing, gold really is now in a phase where it's not inflation that's driving it. Since 2020, the CPI drove gold. Gold and the CPI since 2020 were almost identical until 2024. About midway through, gold just kept going and separated from the dollar, separated from inflation, because gold is now what you're pricing everything else in. Well, oil, I would say, is more comfortably priced in gold now than in dollars. And lots of things I think are being priced in gold. Gold's become this reserve asset that's screaming risk in the system and debt in the system and interest rate troubles. So all of that to say, if in 2026 the economy does not do well, gold's going to continue to run. Will it pause and rest a little bit? From a charting perspective, it looks like it's overdue, because like you said, it's had its best year in forever since we've been charting it, because gold used to be pegged to the dollar. So for a long period of time, gold was, what was it, $33 now or whatever it was. So since true markets have reemerged in the gold space in 1971 through 74, when all of that was being set up to where you're now trading, gold spot prices is on the industrial markets, 1974. It's been the biggest launch. And is gold reflecting all of the past inflation? Is it just reflecting the current problems? I think it's all of it. And so gold and silver could continue to just run and run and run based upon what happens to the economies in 2026, how interest rates go. The Besant was talking about merging the Fed and Treasury rate functions. And what's expected is they're going to do yield curve control. And they're going to try to keep the overall debt service level down. And they're going to, because when they ease, it's going to raise inflation. It's going to put upward pressure on interest rates. So they want to yield curve control it to where, they don't let one end of the yield curve get away from them in a potential default. And they got to monitor things like the repo market. So we're living in a world now which the debt is driving all of the monetary and fiscal decisions in the United States, and gold and silver have figured that out. They figured out the problems that we're having. And no longer do you see these short slams work on the COMEX to where you could have a short slam and it would affect the market for 2 months, and it would take 2 months for gold or silver to recover. Now you slam it and it may be back up the next day. And so it's a very resilient market for gold and silver. And it's basically the market saying, we see risk, especially debt and interest rate risk. And we see currency risk as well on the horizon. So we're pricing that in. And with the central banks being huge buyers since 2011, I mean, the banking industry figured it out. And now the debt industry is figuring it out. And the generalists haven't even come in yet. I mean, there's been investment in like mining stocks and things, but it's not like it was in 2009 through 2011. We're not there yet. So I think there's tremendous upside with these gold and silver companies that are producing, just printing money. I mean, gold, you're probably making, your cost is 50% of an ounce to produce it. And you're making you're doubling that on your profit. And eventually these profits are going to hit the generalist market and people are going to start rotating into the gold stock. We haven't even seen the boom in the gold stocks yet, not gold and silver, not the real one.
Mm-hmm.
It's been nice, but it's nowhere near where it should be, where the profits are in these companies. So I think gold and silver can do extraordinarily well. I think the miners and the equity side, starting in 2026, are going to start doing even more extraordinarily well. And I think that's going to be across the commodities complex too. We're using a lot of copper. Oil probably is going to shortage in terms of well output. So that oil price is probably going to come up. Natural gas has already done well. Nuclear is probably going to be important. Energy is going to be important as well, because I think over the next couple of years, the world's going to try to grow its way out of this debt situation. So you're going to have a lot of easing from the world's central banks pumping money in. That would be positive for gold and silver. It would be positive for all commodities. But it's probably the last big melt up we're going to have. It's looking like that's going to be the last big melt up we have before the true currency crash. That we may have another year or two of money pumping, whatever's left in the Fed's bazooka and the central bank's bazooka. And I think all of those factors are positive for gold and silver. So yeah, I think probably for the first time in history, we're going to have another very strong year in the metals. But it would not surprise me if there is a sharp pullback at some point, because the derivative, even though fiscal is starting to take over, the demand is starting to take over the thinking of the traders on the derivative market. The derivative market is still 99.5% of the trade. Only 0.5% are fiscal deliveries. So there could be a technical pullback at some point. And we can go into like banker positioning. I did a video on that as well, on the COMEX, and how that may be bullish for gold and silver, especially silver going forward. But I don't see a world in which gold and silver don't do well this year, unless magically somehow all of this debt issuance and the high interest rates start to go away.
At the heart of this rally is debt. As sovereign borrowing expands and interest rates hover in the danger zone, gold appears to be front-running fiscal reality. History shows that once governments carry massive debt loads while servicing them at 4 to 6%, stability erodes. Central banks respond predictably: rate cuts, liquidity injections, and monetary easing. The U.S. has already pivoted from peak rates, and further cuts are expected. This environment weakens currencies while strengthening hard assets. Gold isn't reacting to inflation headlines. It's responding to the mathematics of debt that no longer add up.
But I think the gold stocks will, because they're a function of the gold price in terms of profit, the equity side's a leverage investment. I think the mining stocks will accelerate past the growth of gold at some point. It'll slingshot. And this is pretty normal when you have a massive gold bull run, which we're in the middle of a massive. And even though costs are going up, gold price is finally rising faster than inflation. And that's extremely bullish for the mining sector, because it's almost like they're just going to print money, because every single time they print a new ounce, their margins are raising. Every time they announce, new quarterly production, their margins are raising. And I suspect that the equity side of gold and silver is about to have a really big boom cycle. And I'm not sure how long that'll last, but there's going to be a slingshot effect eventually, where retail decides to capital rotate maybe from tech into the mining stocks, and they're going to go absolutely nuts. That's what I talked about last time I was on your show. I talked about the 700-year bond cycle, and people thought I was nuts. They're like, you can't have a 700-year bond cycle. And it's a debt cycle where you're starting to see for the first time the long end across the world raise for the first time, going way, way back, not just in the modern, past 100-year modern economic age, because we're at a place where you have constraints on resources, you have runaway currency printing across the board, and the whole world needs to reset. And I'm told, I was just speaking with someone on the Japanese who would know better than I would on the Japanese side of things, is even though their 30-year is going up, most of the bond rate increases have been on the short end, and they think that they can manage it. But I'll be honest with you, you probably could to an extent, but if your longer term issuances are going up also, that's the market telling you that there's risk. And if you're going to finance your lifestyle, you have to do it increasing rates. And again, once you get to that 4 to 6% range and you have a stack of debt as a developed economy, we're not talking emerging markets where you could take on debt for a very long time. You're talking mature markets that have a lot of debt. You're starting to take a hit to the ability to reinvest in your country and grow your GDP. And we're not even talking things like entitlement programs. We're talking, can you grow your output? Can you grow your manufacturing base? Can you grow those things? And with 4 to 6% interest rates, it gets very difficult to do that. Then you can only do things like raise taxes, and those are all negative. So the fact that these long end of the bond curves are all rising is a worldwide issue. And I think we're about to hit that last easing cycle. Everybody's starting to ease. Everybody's starting to get into that. Let's bring those rates down. But what that's going to do is pump a bunch more money into a system which is already plagued with money. And this is where Austrian economics comes into play. And you look at it and say, okay, we know what the ending always is. The only question is when, because a lot of us thought in 2009 that was the end of it. And here we are 16 years later, and we're way beyond that. So how far can we go before that system breaks? I don't have a clue. I just know that every metric I look at says that we're in fiscal trouble across the world, and they have to go to easing, and it's going to drive gold and silver up. It's just going to drive gold and silver up. I don't see it stopping, really. It could pause for a bit. I don't see it stopping.
Since 2020, gold tracked inflation closely until it didn't. In recent years, it decoupled from consumer prices and the dollar entirely, signaling a deeper shift. Central banks, particularly outside the West, have accumulated gold at record levels, accelerating de-dollarization trends sparked by geopolitical tensions and sanctions. Increasingly, commodities like oil are being priced implicitly in gold rather than fiat currency. This marks gold's return as a neutral reserve asset, one that reflects confidence, or lack thereof, in monetary systems. The metal is no longer reacting to policy, it's judging it.
I think that's why they're monetizing the asset side of the balance sheet with things like Bitcoin and gold, and they're investing in stocks. And now the United States has realized, well, maybe we could grow our way out of it. And hell, we're printing all this money and it's goosing up all these asset valuations. Why aren't we investing in these assets? And so they're definitely doing that. Fiscally, they're trying to be more responsible. They're not dealing with the debt side. It's like if you have a lot of debt, even if you have an increase in income, you still have to bring your debt down, or else you could still be financially insolvent. Because if you're making $50,000 a year, but you're living $100,000 a year lifestyle, eventually you're gonna debt up, and you're not gonna be able to pay that debt service. It's gonna overwhelm your ability to pay, and you're gonna crash. And that's true of the big sovereign governments too. Now, I've also said I don't think people want it to happen right now because there's too much foreign investment into the United States, and it's going to affect everybody. But it gets to a point at which it's going to happen anyway. So eventually, we're going to end up having that crash on the currency. It's just how many years do we have, and is 2026 going to be a growth year? And if the Fed's going to continue to cut, and experts I'm talking to are telling me they're going to cut multiple times, you're going to have a little mini boom. You're going to see more, you're going to see investment in even overvalued sectors like tech. And you're going to see you're going to see interest rates come down on bonds, and there's going to be a lot more issued, and we'll go from 38 trillion to maybe, it wouldn't surprise me if we get to 50 to 60. But then at that point, at 4 to 6% interest, can you survive 60 trillion in debt? But at some point the numbers don't work.
Right.
We're somewhere close to the end of that. For me, at my stage of life, I'm 51. I go physical just because it's so ultra stable. I literally can put my head on the pillow and not worry. But that's not what I would say everybody needs to do. I mean, we could all stand to take a little bit more risk. And I'll just say, in support of the gold and silver industry, we need dollars coming in to get our next gold and silver ounce out of the ground anyway. And if you look at what's going to happen when retail rotates in, there's going to be a physical supply shortage in the US. And if we're going to continue to have more available for people, we need development. The amount of new gold and silver fields that are economic to mine has been decreasing for 20 years. And it's more and more difficult and more expensive. And when you have these asset cycles and people are in things like tech and real estate that tend to bubble up, and bonds and the general stock market, and you don't put money into commodities, the commodities suffer because they're not developing the mines, and they're not developing their next big resource field. So you have two issues. You have the resource fields are small. The big ones have been found, we think, most of them, but they're still out there. It's just that it's more investment, per ounce to get it out of the ground. And growing that and keeping that like up with population increases, things like that can be difficult. So we're in the age of it's more difficult to get new gold and silver reserves. So we've already hit the supply cliff for gold and silver, and for gold, and we're about to hit the supply cliff for silver. Well, we've already hit the supply cliff for silver, but we're not re-engaging the mines that have in the ground. So there are some silver deposits in the ground. We're not engaging them. We're not developing, building them as much as we probably should be. So in addition to all these factors that are raising the relative price in dollars of gold and silver, on the mining side, you just don't have the output, which is another way it's going to build an explosion under the mines, because people are going to see the fact that, hey, I could go buy gold for an ounce, $4,500 an ounce, and I'm going to get X return per year. But if there is no gold or silver coming next year and we have massive shortages, the money's going to be in the mining stock, the equity side of the business. And so the equities, and if you look at like 2008 through 2011, I say 2008 before, because 2009 really was the bottoming of the markets, and then the rebound started February 1st, February 2nd. So, but if you look at 2008, 2011, the mining stocks really had their boom after gold and silver, and gold retreated. They retreated at different times. So typically the mining stocks will come a little bit later, and people aren't believing the generalists aren't believing the mining stock story just yet, but eventually they're going to have to. When you look at the S&P down against gold, that kind of chart, people eventually figure it out, and they're eventually going to come into those mining stocks. So I do think the mining stocks are going to be very positive going forward. Of course, you have to have good names with good asset. Either they're producing or they have really good assets in the ground. And that's a very technical and hard analysis to do. It's not for everybody. So the mining stocks may not be for everyone, but certainly they're going to be potentially explosive. And for two reasons: they need to catch up to the gold price and the money that the producers are now basically printing every time they produce a gold or silver ounce, and how much ridiculous return that they're getting for their dollar. But there's going to be an explosive demand for new development. And we're about to get into an era in which you see a lot of new projects come online, a lot of new companies come online, looking for capital to finance their drilling and all of that kind of stuff. That's coming very soon. It's already started, but we really haven't seen that explosion like we saw in the 2008, 2011 timeframe. I think there's a tremendous amount of upside on the gold and silver stocks for sure. Just be careful when you get into them. It's a very difficult market to analyze.
Despite record metal prices, mining equities remain surprisingly restrained. Historically, this lag is normal. Gold and silver move first, miners follow later, often explosively. Today's producers are generating exceptional margins, with production costs far below spot prices. Yet generalist investors remain absent, still anchored to technology and financial assets. That disconnect won't last. As earnings compound and balance sheets strengthen, mining stocks become impossible to ignore. When capital rotation begins, miners typically outperform the metals themselves. The leverage embedded in these companies sets the stage for a delayed but powerful revaluation.
It's the next ounce in the ground, and the mining stock sector, we had a little blip in 2016 in mining stocks, and we had a little blip in 2020. Those are both points at which the gold price was rising and people got in stocks. But the gold price rallies were not extended rallies like we're seeing now, because they really were, it's sort of like aftershocks, but they're pre-shocks. They're little disturbances in the market that cause gold to go up, which then brings investment from gold into the stocks, because the metals price will go up first. Then people will see the stocks are attractive. Then they'll get into the equity space. But those were little baby markets. This is not a baby market. This is an extended, it's the reddest hot gold and silver market you could ever chart in the US based on the way they've traded. Basically, you just go back to 1974. You can't really go back before then because it was money and it was pegged and all these other kinds of things. So you really just go back to 74. And since 74, this has been the hottest gold and silver market in US history. And we haven't even seen the beginning of the returns that you'll see in the equity space, and this is going to be extended. So this is going to be the next big. So they were neglected for a long time. A lot of stuff put on care and maintenance. I visited a lot of mines. I talked to a lot of, they didn't want to talk about investment. They're like, I went to PDAC last year in March. I'm going again in March of this year. And I was offering free coverage for these gold and silver mining stocks, especially the ones that were doing well, because I wanted investors to see them so they could start doing research. They would not come on camera. I literally went to the site on my phone and did a couple of live spots saying, hey, I just thought this company could be a good one. They don't even want to address the public, because for the last 3 or 4 years, it's been nobody's loved them, nobody's cared. And it's at the point where it's almost like these mining companies, it's almost like a jinx. They're like, they don't feel like it's the right time. And I think that's going to change. I think that they're going to start telling their stories, but it's almost like the mining stocks will go into hibernation when gold's not doing well. Well, now that we've had gold doing well, I expect you to start to see a lot more mining companies come out and telling their stories. And when I go to PDAC this year in March, I'm going to give my little presentation on the investment forum leaders stage thingy. And then I'm just going to go talk, and I'm going to see if the vibe is different this year. The vibe last year was cautiously optimistic. We've had a big boom, but nobody's investing, and when we look at the investors on the floor, predominantly they're the older generations, and the new investor, there are some. It wasn't robust. It was not the best attended PDAC, the biggest mining conference in the world. This year, I want to see if it's going to be different. I have a feeling, based on what's happened to silver, because usually it's gold and then silver and then mining stocks, pretty typically, in terms of what breaks out. So you have gold break out first, silver follows, and eventually the mining stocks is a confirming bull market signal. And I would be shocked if by March there's not tremendous interest. I want to see whether the younger generations have interest in the stocks, or it's going to take something like the mining companies getting into tokenizing assets to draw them in. It may be they need to go digital, and that's something we're paying attention to. Tokenization is becoming a bigger subject in the resource space. Maybe that's how you get the young investor. But I definitely think they're compelling.
Beyond monetary forces, physical constraints are tightening. New gold and silver discoveries have declined for decades, while development costs have surged. Many viable projects were shelved during years of underinvestment. As demand rises, driven by electrification, energy transitions, and financial hedging, supply struggles to respond. Silver, in particular, faces a looming deficit due to industrial use in solar, electronics, and defense technologies. This imbalance amplifies price pressure and elevates the strategic value of producers and developers. Scarcity is no longer theoretical, it's becoming measurable, and markets are beginning to notice.
Yeah, and during the 2008 timeframe is when a lot of Gen Xers, my generation, got involved in gold and silver that weren't before either, because there was a crisis, and all of a sudden they looked at the prices and they got interested. So I think each time you have a crisis, some sort of fiscal or economic crisis, you bring in the new generation. So I definitely think that is happening and will continue to happen. I also want to address, now that we have a minute, to talk about the recent rumors on the COMEX, if you don't mind.
Yeah,
Talking
floor
about
is yours.
the new generation and new technologies with AI. There's an AI video running around talking about things like CFTC emergency meetings, and a lot of social media buzz around JP Morgan flipping long. There's no way to confirm any of those things. And I did go back and look at the bank participation reports, and the US banks are now net long silver for the first time I've ever seen. But as a percentage of the overall bullion banks, the non-US banks have a larger short position. So there is bank repositioning long in silver, the 5 US banks, but overall there's still tremendous short pressure. So some of what you hear that goes on in social media with regards to the silver market, the COMEX exchange, those trades, is somewhat true, but it's not quite, what's being depicted. And I want to address it because a lot of times, especially the younger generations, if they're just getting in, they're going to see a video like that and they're so used to that type of content that they're going to attach to it and say, okay, this is what's going on. I just want to caution people with that kind of stuff. I don't think there's an imminent default going on in COMEX. If any of the data they report is true, certainly we've had their issues with their data and manipulation. I've covered that many times, but I don't see an imminent default there. And I think the US government is also, they trade on that market, probably through JP Morgan and the other commercial banks, and they don't want it to fail. So they're going to bazooka print money and do cash settlements before they allow the COMEX market to fail. Not saying it can't fail. I'm just saying we're not at the stage where it's imminent failure. And I wanted to address that rumor because what will happen is people will get in, and I've seen it before, people will get into silver, and then if it pulls back and they get angry if what was said doesn't immediately happen. I had it happen a couple of years ago. People were getting angry when silver fell back down to like the $21 range when it had been near 30 a few years ago, and they were frustrated. And I said, just be patient because it's coming. And now we're at silver 71 and it's more than tripled. And if you simply held it, you tripled your money in about a year and a half. So there is a longer term price trend up for gold and silver. Certainly the fundamentals are very positive. I just warn people to be very careful when you watch social media content and you just believe what's in it. And one of the reports said, The Economist said something, and it wasn't The Economist, it was Economic Times. It was not that level of publication. And when we looked at the Economic Times article, it was referencing a reader report. It wasn't a market analyst or data or anything like that. So a lot of this reporting on imminent failure of the US trading markets in silver is based on rumors and people that aren't typically associated as being experts on the market. But I can't find a lot of evidence that a lot of that is distinctly true. There has been movement in the banks, in the US banks going that long. It's a drop in the bucket of the overall bank positioning. It could be signaling that we're having another big leg of the bull market come because they're doing this, and it probably is. But the imminent failure and breaking of the physical deliveries on the COMEX is not, I don't see that around the corner. So I just wanted, and people are getting really mad at me for saying this.
And we don't need it. Rumors of imminent market failure and exchange defaults circulate widely online, but disciplined investors must separate noise from data. While bank positioning has shifted and volatility is real, systemic collapse is not immediate. Precious metals markets remain resilient, rebounding rapidly from sell-offs, a sign of underlying strength. For investors, patience is critical. Gold and silver are long-cycle assets, not overnight trades. Pullbacks will happen, but the broader trajectory remains intact. As debt expands and currencies weaken, metals and eventually mining equities stand positioned for a defining cycle that may reshape portfolios for years to come.